so far in 2026, Bitcoin is up like over 3%, and flows are about 2% of total ETF flows on the cumulative.
All right, joining me will be Matt Bartolini, Global Head of Research Strategist at State Street Investment Management. Of course, State Street is currently the country's third largest ETF issuer, and globally, they have $2 trillion in ETF assets across some 300 plus products. And I always say, Matt is simply one of my favorite industry resources. I just love his ability to talk both ETFs and financial markets. And that's exactly what we'll be doing this week, because Matt has provided me with three key areas that he's finding most interesting right now. These span both ETFs and the financial markets. So we're going to unpack each of these areas. And I would say all three definitely offer some really good food for thought in terms of your own portfolio construction as we get into 2026 here. So Matt will join me a bit later. To start this week, though, I'll be joined by Cinthia Murphy, investment strategist at VettaFi. And I think most people who listen to or watch ETF Prime are aware that I do these 5 ETF predictions every year. And I actually released this year's predictions a couple of weeks ago, but I haven't yet had a chance to discuss them on here. And so Cynthia and I are going to do that this week, which I'm very excited about. And since we are at least a little late here in getting to these, this will also give us a chance to do some early grading on my predictions. We'll see how things are looking so far, which, by the way, I will be the first to admit it has been a bit of a rough go for me over the past couple of years on these predictions. But I'm looking forward to getting back on track this year, and I am feeling pretty good about things so far. So we'll see what Cynthia has to say. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. So let me now bring in the formal grader for my ETF predictions, VettaFi Cinthia Murphy. Cynthia, I am going for straight A's this year after failing quite a few predictions over the past several years.
Definitely a strong start, Nate. Great predictions, actually. I think all your predictions are spot on. They're always spot on. And, as you know, my track record with predictions, I only did it for the first time last year. And my big prediction for the year, if you remember, was two things. One was assets were not going to beat the previous year record. And boy, I was wrong by at least 30%, huge off the mark. And then small caps, and I just like to think I was early to that one, not that I was wrong. So small caps are turning out to be a great 2026 theme. So, hey, who am I to judge anybody's track record? But I love this exercise of kicking the tires on how predictions are going, even though we only have 2 weeks to go really on data here. But there's already some inkling on how this is going.
Yeah, I agree. And I just think I like doing these predictions because it actually helps me keep my finger on the pulse of what's going on in the industry, really trying to think ahead how the industry might evolve, what may be in store for us as we head through the year. And so I thought, let's just go through these one at a time. And I truly can't wait to hear what you think on these. So just let me have it. Like, don't hold back on what you think here. So the first prediction I have, I would say, was definitely colored by some big news we had in the ETF space towards the end of last year. And that was Goldman Sachs announcing the acquisition of Innovator ETFs. Of course, Innovator, that's a $30 billion issuer of primarily defined outcome ETFs. And my prediction is that this is going to be the first of what will be several notable acquisitions over the next year. So I think we're going to see some real consolidation in the ETF space in 2026 with larger asset managers scooping up smaller ETF issuers. So what did you think about this prediction?
I think it makes total sense. I'm actually surprised we haven't seen more yet. If you think about, and we just saw, was it last week, the announcement Raymond James is acquiring Clark Capital. Now, Clark Capital is an advisory business, but still, it's the joining of the forces. Raymond James just entered the ETF space. So I'm surprised it hasn't happened sooner and faster. If we have over, I was looking at ETF GI data recently, and we have over 400 unique brands, ETF brands. As you know, we have over 4,000 products. We have so many more come, new entrants every week. We've already had 49 launches this year of new ETFs. So I think this is all about that scale and distribution. The easiest path to that for a new entrant, especially, is through acquisition, is through mergers. There is no room really for differentiation, for grassroots efforts anymore. At least it feels that way. So I'm surprised we haven't seen more. I would think we're going to see a lot more, and it makes perfect sense.
I love it. So you're agreeing with my first prediction. And I'll just say, we both know how competitive the ETF industry is. It is so tough to find success. And the way I think about this is twofold, in that we have, over the past several years, had these really name brand, larger asset managers come into the ETF space. They typically have some pretty good distribution. They're known among advisors. But if you start looking at their product offerings, they don't feel very differentiated, to exactly what you were saying. Not in every case. I'm painting with a broad brush here, but in general, a lot of the product looks a lot like what's already on the market. And then on the other hand, we have all of these upstart ETF issuers who are coming to market with some really innovative ideas. And I just think that if you can marry those two, where you have these larger issuers, they find the right smaller issuer who their product lineup fits into what they want to do or what they want to be, that just seems like a good marriage. And so to me, it's about surviving and thriving in the ETF Terrordome. And I do expect that we'll see a number of acquisitions this year, which, by the way, I'm not entirely sure how to grade this at the end of the year. I just thought I'll let you and our other industry friends.
Let's just do number of deals. Let's just randomly throw a number out there. Like, what do you think? Five? Is five a lot?
Yeah, I mean, I think 5 would be a lot with what we have seen historically, but I'm fine if we want to lock in somewhere around there. I just think that we will see enough meaningful transactions that it will be clear that I was right. So how about that? You can
Then
you can be the
do
judge at
three
the.
then. Let's just say three, and Ray J counts as one already. Let's just, how about we help you out there?
All right, that's it. That sounds good. Okay, my second prediction is that smart beta ETFs, you remember those smart beta ETFs? I think they're going to make a big comeback in 2026. And essentially, I just think a growing number of investors are concerned about equity valuations in the US. I think they're worried about the top heaviness of the S&P 500 and the Nasdaq 100. And so they are going to be looking for ways to maintain US equity exposure, because that has been a good place to be, right? You don't just want to shun US equity exposure. However, investors don't want that market cap weighting. And so I think they'll look at things like equal weighting or factors such as quality or value. And I think that's going to bode very well for smart beta ETF. So my specific prediction is that smart beta ETF inflows will double to 75 billion this year. They were at $37 billion last year. And by the way, all of my asset figures I actually got from State Street's Matt Bartolini, who will join us later. But there are a lot of flavors of smart beta. We've seen a lot of active ETFs come to market that, even though they're technically active, they smell, they look like smart beta. But I'm going to say, State Street's categorization here with the numbers I gave, that's how I'm going to grade this prediction. But I do think we're going to see these start making a comeback after, this was a big story in 2016, 2017. I think we're coming full circle here.
Well, we've seen flows already start to pick up on this category last year. If you look this year, RSP, which is the S&P 500 equal weight, is already number 4 in biggest flows for the year. So there we are. I agree with you that I think market concentration, our obsession with Mag 7, big tech growth names, has brought us back to smart beta, where all of a sudden we're like, wait a second, maybe there's different ways to access this market and not be so concentrated. I think from a product development too, there's been some interesting launches. Interestingly, I was looking at the 49 launches so far this year. There's none of them that look smart beta to me. But we've all the different ways, like the historical weight of the S&P 500, a different way to think about some S&P 500 stocks, which Tema launched, I think last year. We have Arnott, who's done different ways of market cap, or the pure market cap that Global X launched last year. It's been kind of really fascinating just within the S&P 500 universe to see folks trying to reinvent a little bit the weighting scheme so that you can still access S&P 500, but not be so top heavy, so concentrated, or be super concentrated, completely unrestrained. So I think product development has been interesting. It has tilted towards that quality, towards that kind of a little bit defense within your offense, which I think is just a sign of the times. So it makes sense. But to your point, for us who watch the space, the challenge is, what is smart beta anymore? Because other than this the clean cuts, the factors and stuff, we live in the era of the active overlay, and an active overlay throws every categorization out the window. It's not really active, it's not really passive. And so I think that's the only thing that makes counting the assets and where the action is a little tricky, because it becomes a little subjective, which is a new thing for us as well. But definitely makes sense as folks try to manage concentration and equity exposure.
Yeah, I agree on your point again with how do we quantify this, which is why I'm just going to use State Street's classifications here just to stay consistent. But to your point, there's been some really interesting product development here. That Tema ETF you mentioned with a historical weighting in the S&P 500, I think is an interesting concept. You mentioned Rob Arnott. He continues to come out with some different products. I just think we're going to see a huge uptake in this space. Interestingly, the record for smart beta ETF inflows is 103 billion, which was set in 2022. And of course, 2022 was not a great year in the market. So I'm not making any sort of market call, but I will say if we do see stocks start to roll over a little bit, I will actually feel more bullish about this prediction, because I think that's going to be the catalyst to have investors look to this space. Because if you look even right now, you mentioned RSP, the Invesco S&P 500 Equal Weight ETF. That is number 4 in inflows overall this year, about $4 billion, which looks good for my prediction. However, if you look at the top of the leaderboard, what do you see? It's VU, it's SPYM. So investors are still allocating there. And I do think it will probably take at least some market turmoil to sort of light the fire under this prediction. But it sounds like in general you're on board, so I'm going to take that as a good thing.
I give a green check mark on that one.
All right, good. All right, my third prediction, which I had to sneak in something crypto related. My third prediction is that the crypto index ETF category will triple this year, with assets going from about 1.7 billion to over 5 billion. And I'm not going to belabor my points on this one. I feel like I've talked a lot on here about how bullish I am on crypto index ETFs. But I will say the basic rationale here is that I just think a lot of investors and advisors actually do want exposure to crypto, but they don't want to be in the business of trying to pick individual winners and losers. And so obviously, crypto index ETFs, those are an easy button approach. It's really that simple. So any arguments from you on this one?
So I agree, and I love the concept. I just think we haven't seen it yet. So I pulled out some numbers this morning, which I'm going to look them up here right now, Nate. Year to date, first of all, on inflows, $2 billion in inflows year to date. Where is all gone? IBIT, ETH, tiny bit on XRP. So the money keeps flowing to your iShares Bitcoin fund, your iShares Ethereum fund, and that's pretty much it. So I love the solutions that we have today in the market. I love the market cap indexes. I love the multi-token in one basket. It all makes so much easier, makes so much sense. Even if you want to do like a Bitcoin exposure and then complement with something else. But we're just not seeing the flows there yet. Could they come? I mean, it makes sense. And I'm really cheering for the category and for them to come, because I think these products are really smart. But what's interesting is, so I was looking at flows, is that so far in 2026, Bitcoin is up like over 3%, and flows are about 2% of total ETF flows. on the cumulative. Last year, Bitcoin was down 10% and flows were 3.5% of total flows. So it's almost like as the market struggled, the crypto market, folks put more money on a relative perspective to the total market than they're doing this year as the prices are recovering. So crypto is super interesting. It makes sense, but then a lot of times the behavior we see doesn't make sense. So it's always a little bit of a mystery box to me. I think it's getting demystified as products evolve, as advisors feel more comfortable with it. But this is the prediction that to me can go anyway, either way.
So you're skeptical on this one overall.
I just think we remain really attached to the Bitcoin play. I'm not sure that we're ready to embrace the other ones, even though they make so much sense.
So I have come prepared today. I had a feeling you might rebut this one. So I'm going to use VettaFi's own data against you, because do you know what came out last week? Last week, we saw the latest Bitwise-VettaFi survey of financial advisor attitudes toward crypto assets. And one of the findings was that 42% of advisors, 42%, said they would prefer to buy a crypto index ETF over individual token ETFs. Now, there is a huge caveat on that, to your point, that excluded Bitcoin and Ether ETFs, which have obviously been on the market for a while now. So my guess is that's why those were excluded from the question. But crypto index ETFs were by far the top answer. I think Solana ETFs were second with like 19% or something like that. But I think that is a good indication of how advisors are thinking about the space. And maybe right now, because it is still very early with crypto index ETFs, those just came out in, October of last year, somewhere around that time frame, maybe a little bit earlier. I don't know that there's been enough education around those, and maybe advisors are just taking a little bit of a wait and see, not on taking an index-based approach to crypto, but just letting those ETFs continue to get a little bit of traction, and just feel comfortable around the trading history and those sorts of things. So I feel good about this prediction. If we get the Clarity Act passed, which that's not looking great right now, but I still think there's a decent chance of that. So that'd be the Digital Asset Market Infrastructure Bill, essentially. I think that will be a tailwind behind the crypto space overall. And I do think more advisors are just getting comfortable with owning this in a portfolio. So we'll see. I understand what you're saying, and that Bitcoin ETFs and then Ether to a lesser degree, they've been out there. Advisors are definitely much more comfortable with those. Do they want to go down the cap spectrum and start owning things like Solana and XRP? I get it. I just think that ultimately they'll come around on that. Historically, I have been known to be very early on my predictions, which I take as a good thing. But what is it if you're early, you're still wrong, right? There's some sort of quote around that.
That's how I felt about that small caps last year. You're early, you're still wrong. No, I totally agree, Nate. I think it could, even to your point about education or understanding, if you're an advisor and you're telling a client, hey, buy this index because you get all of these crypto assets in there. For us, okay, that makes sense, but it could be a situation where they still have to explain, why do you need Solana? Why do you need XRP? Why do you need this? Why do you need that? And maybe they don't have that answer yet. So maybe that could actually be deterring they can't like confidently make an investment case other than, as a category, you should own this. So it could just be a slow go there, but we're getting there.
But my rebuttal to that would be that's no different than investing in the S&P 500. I don't think advisors can sit and make a strong argument for every single stock that's in that index. And I know there's, we're talking 500 plus stocks there versus, say, 10 in a crypto index ETF. But I think it's the same point, in that if you want exposure to a category overall, we know on the equity side and fixed income side, taking an index-based approach over the long term is typically pretty beneficial, especially if it's low cost exposure. So we'll see here. I appreciate your skepticism, and the good news is we can grade these at the end of the year. Okay, let's get to my fourth prediction, which is that international equity ETFs will smash their annual inflow record. So last year, they pulled in about $250 billion. That beat 2021's record of $198 billion. I think they will easily shatter last year's record this year. And I would point to three main drivers here. So I think last year's outperformance by international stocks really caught the attention of investors and advisors. And so I think there will just be some very simple performance chasing here. I also, as I mentioned earlier, I think there are some real concerns around US equity valuations. And so I think investors and advisors will be more apt to look overseas. And then I do think there are several factors pointing to a weaker US dollar. And again, I'm not making a market call. I'm just saying if you take a step back, you look at some of what the Trump administration is trying to do, you look at where interest rates are heading, I think that you can make the case the dollar is going to have some continued weakness. That would bode well for international stocks. And so I think all of this points to a really big year for international equity ETF. So what do you think about that one?
I love that because last year you were the skeptic on the international. So this is the come around story. So I love that.
See, I'm intellectually honest. I can change my mind when the data presents itself.
I remember last year when we talked about predictions, your point was 1 year doesn't make a trend. Is this going to be sticky enough? And what we're seeing is exactly that. It has been sticky. I actually think from an international equity category, developed and emerging together, it really was in 2025 that it's the value play, the diversifier play, and then they performed well. And now all of a sudden, when you look at all the market outlooks, all the conversations really has become more of a fundamental strength play. So this isn't just chasing value anymore because the valuation gap to US equities has narrowed a lot in some, countries. But it's really about just kind of like a quality play. There's earnings growth now that is looking compelling. IEMG, the emerging markets ETF, is already a top 3 as a gatherer this year. We're seeing, all your Vanguard usual suspects, VXUS, all those funds are also on the top leaderboard. So I think it's cool because in my mind, this is an opportunity that started last year. We kicked the tires on it. It delivered. Now there is growth behind this valuation play. There is like substance there. So I think we're going to be seeing a broadening of that opportunity set this year. So it could be really interesting. I mean, look for any market outlook that doesn't single out emerging markets. When you add also the commodity cycle to it, the currency, to your point, opportunity. So is it going to beat the US? I mean, it could, but I don't know that even matters as much as it is just it's looking robust, and folks are definitely finally buying in significantly.
Yeah, and part of my thinking here too is just that I think there's a significant home country bias in portfolios, and that bias has grown over the past 10 or 15 years, rightfully so. I think you had a lot of, especially financial advisors, who had pretty meaningful allocations to international stocks. If you go back to say 2010 or 2015, and owning that, they substantially underperformed. They had clients coming to them going, look at performance here. Why do we own international stocks, which aren't doing anything? And so I think there was some pressure over time for advisors to have U.S. equities dominate their portfolios, which again ended up being a good thing. And that may be the case moving forward. But with how much international equities outperformed U.S. last year, there was a big enough delta that I think it's going to get advisors' attention, especially if it continues. And with that significant overweight in U.S. equities, I think we could really see a switch there to where they move into international equity ETFs, which, by the way, if you look at inflow so far this year, the iShares Core MSCI Emerging Markets ETF, IEMG, guess what? That's number 3 on the inflow leaderboard, $5 billion. So good early sign for me on this one.
Some categories beyond your broad benchmark, the tickers that are the most popular, we've seen companies like American Century, Avantis. I mean, they're emerging markets funds. They've been delivering. There's a lot of managers, Capital Group, a lot of managers delivering a lot of really interesting performance in this space, given their quality focus or active approach. So there's a lot to go dig for in international equities this year. I think it's going to be an exciting year to watch.
Well, you made a great point towards the end of last year where you thought maybe individual country ETFs could see some uptick, where if again, we continue to see this general international outperformance, that investors maybe get a little bit more tactical here and try to play some countries that might have greater upside. So I think that's also a space to watch, the individual country ETFs. Okay, my last prediction here. This one's a little boring, I'll admit, but I think it's an important one. And the prediction is that this will be the year of fixed income ETFs. So fixed income ETFs, they took in about $450 billion last year. That easily beat 2024's record of just over $300 billion. And I think this category is just getting started. And so my prediction for 2026 is that this will be another record year for fixed income ETFs, not only in inflows. I think we're going to see a bunch of launches in this category. We'll see continued innovation, because I think there's still a lot of white space here when issuers are looking at where they can compete. I just think it's going to be a big year overall for fixed income ETFs. So any disagreement from you on this prediction?
No, flows so far this year, I like the percentages of total bond ETFs have taken in 32% of all flows this year. Last year, which was a record, it took 29% of all flows. So we're already ahead of pace on a relative basis. Well, I think what's interesting is, if you look at the top most popular funds, last year was all about that short end, fund, SGov, things like 0 to 1. This year, that's shifting a little bit. There's a lot of movement in, the belly of the curve. So if you look at the top flows, they're all in funds that, SGov is still there, but funds that have that, like the average duration of about 6 years, for 3.5%, 3.84% yield. So we're seeing a little bit of that extension into duration, nothing long, but just a little bit more locking in those yields in the belly of the curve. I think this would be a really tactical year for folks in fixed income, trying to lock some yield there, trying to get some capital appreciation if rates do keep coming down. So I think it would be definitely interesting. And on the product development side, as you know, VettaFi acquired Credit Suisse last year, the fixed income indexes. And there's been so much movement on developing new, interesting fixed income indexes here in our own shop, different ways to really rejigger the ag, rethink the ag, and finding new, interesting ways. So it's very exciting. Fixed income is actually not boring at all this year. I think it'll be a great year for fixed income ETFs.
Well, you actually helped me on this prediction, because again, back in December when we last visited, you provided some VettaFi survey data, which found that 75% of advisors were expecting lower interest rates this year. And so part of my rationale is, well, if that's the case, I think these advisors are going to be proactive in seeking out higher yields, which will bode well for the fixed income ETF category overall. And then not only that, and I wrote about this in the piece, there's a record like $7.6 trillion currently sitting in money market funds, which, as we know, again, yields have come down in those. And I think a chunk of that money is going to flow out, and guess where it's going to find a home? Fixed income ETFs. Because if you're investing in money market funds in general, you're doing that because you're conservative, right? You want to sit in cash. So I don't think that money's going to come out and go into crypto ETFs or equity ETFs. I think it's going to go into fixed income ETFs, perhaps in pursuit of higher yield. So I think all of that bodes really well for the category. But Cynthia, again, you're going to get to do the final grading on these predictions at the end of the year, which, by the way, I should have noted, these are posted at the etfeducator.com. But I feel like after we've gone through those, you're mostly on board here. So again, that bodes very well for me. I think I'm going 5 for 5 this year.
It's an honor to be the grader. I will be watching, and I'm very excited for the year ahead, Nate.
Thank you for joining me this week.
Thank you so much.
That was Cinthia Murphy, investment strategist at VettaFi.
Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR.
I'm now joined by Matt Bartolini, Global Head of Research Strategist at State Street Investment Management, who currently has $2 trillion in global ETF assets across 311 products. And as I mentioned at the top, Matt is simply one of my favorite industry resources to visit with. I feel like he covers ETFs and the financial markets as well as anyone, anywhere. And he's now joining me from Boston. Matt, it is always great having you on the podcast. Thank you for joining me.
Yeah, Nate, I love being on. Thanks for having me back.
Okay, so you provided me with 3 areas that you're finding most interesting right now. So these span both ETFs and the financial markets. And I thought, let's just dive right in here. I thought all of these were very topical and timely. I think these are all relevant to investors right now as they think about portfolio construction moving forward. And so we're going to dive right in here. And the first area you mentioned was small cap stocks. And you noted how through the first 7 months of last year, small cap ETFs had about $20 billion in outflows. But then since August, they took in about $13 billion, actually taking in new money 4 out of the last 5 months of the year. And so first, I'd love to have you just talk about the ride small cap stocks and small cap ETFs took last year, and then we can get into what might lie ahead.
Yeah, I mean, those first 7 months, it was really marked by significant economic uncertainty from trade policies coming into the fore, but also at the same time, we had the labor market that was starting to really show some softening. And also the Federal Reserve really had been sort of holding steady in their policy rates through the first part of 2025. Then around the summertime, you started to see a little bit of a relaxation of some of those onerous trade policies, stepping back from the brink of what might have been the worst case scenario as it relates to tariffs. At the same time, you start to have the Federal Reserve sort of signaling that they're going to be easing their policy rates and not just doing it on a one-off, but maybe potentially for multiple meetings, and that since has happened. But at the same token, you then also had the One Big Beautiful Bill Act acting as a fiscal impulse to the broader economy, which would also benefit consumptions and corporations in terms of their bottom line, with a lot of those sort of tax incentives coming online in 2026. So at that time, you started to see the monetary impulse of the potential for lower rates and lowering the cost of money, fiscal impulse in terms of boosting growth and consumption. And that led to a revision upwards of small cap earnings estimates for 2026 fulsomely growth. And that led to a rally in small cap stocks, where small cap stocks outpaced large cap to end the year. And that is something we had seen before when you had policy rates being lowered, but you now had these sort of 3 impulses really benefiting small caps from that perspective. And they really have been at their nadir in terms of sentiment. Last year, everything was at records in the ETF market, except for small caps, because small caps had the opposite. They had record outflows, and they actually still ended up having record outflows as well.
I think many investors understand this, but why might lower interest rates or, say, a step back from a trade war benefit small cap stocks? I think with a fiscal impulse, as you mentioned, which can boost economic growth, clearly that makes sense, why that could be beneficial for small caps. But what about lower interest rates or, again, a step back from a trade war?
Yeah, on the lower interest rates, small caps tend to have a higher debt load than large caps, and that can eat into their bottom line and their earnings. And this is happening when also you do have some of the provisions in the One Big Beautiful Bill Act actually impacting small caps more greatly than large caps in terms of changing the expense reductions instead of EBIT to EBITDA, which actually be a benefit to small caps because they have a greater EBITDA to EBIT ratio, if you look at it from that perspective. Something we wrote about back in July when that bill was coming online. But the lower borrowing cost, it lowers the cost of money. Small caps tend to have a higher debt load. That could be a benefit to bottom lines. Small caps tend to have more floating rate debt as well than large caps if we look at their entire overall capital structure. So that would be one benefit from that perspective. The second one, in terms of trade war, just less uncertainty, less economic uncertainty, less consumer uncertainty. And I think that would benefit just risk sentiment and risk temperament, which is, again, what we saw in the second half of 2025, since the end of July, small caps had outpaced large caps by about 6% to end the year.
Okay, so with that as the backdrop, I guess now talk about your general outlook on small caps moving forward. And as always, for everyone watching or listening, this is not investment advice. Do your own homework. But, Matt, do you think the recent uptick in small caps is sustainable?
So, I mean, I think when we take a step back, when we look at some of those foundations, right? So, monetary policy, again, we don't know what monetary policy is going to look like in 2026. We're obviously going to have a new Fed chair. The direction of travel potentially is for lower rates, and we do know that historically, that small caps have outperformed large caps by an average of 6% over the following 12 months after a Fed rate cut, outperforming 72% of the time. So there's that sort of historical continent in terms of, or historical connection, I should say, in terms of policy rates being lowered, benefiting small caps relative to large caps. I think secondarily, those fiscal impulses from the One Big Beautiful Bill Act on growth would be a benefit to the bottom line. And that's why we started to see, if we look at small caps, they're projected to have double-digit earnings growth next year, basically on par, depending on what day you're looking at and how the estimates are changing day over day because we're in earnings season, but roughly around 16 to 18% earnings growth in 2026 because of those fiscal and monetary impulses. Now, you can say, well, large caps are doing the same thing, so why would I sort of travel down the cap spectrum and maybe take on some of that small cap risk, even if earnings are the same? The price that you're paying for the earnings is actually quite attractive. So small caps next 12-month price to earnings ratio is trading at a 12% discount to its sort of pre-pandemic 5-year average and a 36% discount relative to large caps. So it's cheap on an absolute basis and then a relative basis to large caps as well. So you're getting that earnings, that cash flow at a really attractive valuation point.
Let me ask you this. You have been joining this podcast for many years. And so, I like to take a full 360-degree view of anything that we're looking at on here. And I'm curious if you have any thoughts on this narrative that perhaps small caps aren't what they used to be because a growing number of the best up and coming companies are staying private longer. And so when they do finally go public, they're already large caps, right? And then there's also this thought that the largest companies out there are continually scooping up the rising small cap companies. And so those small cap companies, they don't really get a chance to contribute the same returns to small cap indices that maybe they did in the past. And so when I'm trying to think of potential negatives, we can talk about more attractive valuations in small caps and those sorts of things, the potential tailwinds that you mentioned earlier. But what about on this other side? Do you have any thoughts around either of those narratives?
Yeah, so if that narrative of larger companies snapping up smaller companies, plays out because of vibrant growth activity, that could be a benefit to small caps in this current market because M&A activity could boost prices and valuations, not only for the company being acquired, but then relative companies in the same industry or, in a tangential industry as well, that would then say, okay, well, if that company is being taken out at XYZ multiple, perhaps I'm worth that as well. It's sort of like when professional sports teams get, taken out at $12 billion and everyone starts to assume they could be billion-dollar franchises, even though they've never won a Super Bowl. Now, the thing is, small caps are small caps. If a company never entered into the small cap realm because it was snapped up before it went public, that's just how markets have manifested themselves over the last 30, 40, 50 years ever. That's always been the case. I think if we're looking at the small caps right now, the small cap exposures, they do have those sort of benefits in terms of monetary and fiscal impulses. And again, if they are going to be taken out because of some lofty growth expectations in a, say, highly innovative industry, that could be a benefit because M&A activity could potentially, boost prices.
All right, before we move on, because I want to make sure we have plenty of time for the other two areas that you're watching, obviously State Street offers several ways to play small cap stocks via ETFs, including SPSM, right? The State Street Spider Portfolio S&P 600 small cap ETF. There are also growth and value small cap ETFs. State Street has a low vol version. Any words of wisdom you might offer to ETF investors seeking to allocate to small caps?
Yeah, I mean, SPSM, 3 basis points, cheapest S&P 600 small cap ETF out there, cheapest sort of small cap in its own right from a low cost core perspective. I would say in this type of market environment, where you do have buying behavior. And that's kind of the big thing too here. Is like this is a little bit of a contrarian play because in a massive year of inflows everywhere, this is a market that had outflows on a yearly basis. I would just say try to pick up the beta exposure for that snapback rally that is potentially there, given, again, those monetary and fiscal foundations supported by positive earnings growth expectations at attractive valuations. So I just sort of pick up that beta, maybe not make that distinction between value and growth at this moment, and just try to get that sort of beta exposure to small caps.
All right, so small caps are the first area you're watching. The second area that you noted that you're finding most interesting right now is actively managed ETFs. And you said flows are clearly showing a greater preference by investors to be active with ETFs. And I have several questions around this topic, but I guess first talk about those flows in terms of what you're seeing right now around investor interest.
Yeah, so we broke this down into sort of like four factors, but like that first one around flows, flows show a greater preference to be active with ETFs, and that's sort of the framing of that one. So active ETFs took in a record 580 billion of inflows in 2025. It was driven by record flows in equities, bonds, and then in that melting pot of an other alts type category. Now, if we look at mutual funds, right, and this is where we say it's a greater preference to be active with ETFs. Look at mutual funds. Mutual funds had 640 billion of outflows, where only active bond mutual funds had inflows. So equities in that melting pot of other category had massive outflows. And if we look over the past decade, active ETFs now have 1.2 trillion of inflows over the last decade, compared to nearly 4 trillion of outflows for active mutual funds. So that's when we look at the data and say, okay, if you're going to be active, what type of wrapper? And there's a greater preference to be active with ETFs.
And to be clear, this isn't just with equity ETFs, right? This is with active fixed income ETFs as well.
Yeah, it's active equity, it's active fixed income ETFs, it's active alternative ETFs. Every single one of those big three categories all had record flows in 2025.
I know there are obviously many shades of active. We were actually talking about this in the previous segment, but if we think about more traditional active in general, I think most investors believe the majority of active managers underperform their benchmark indices, especially on the equity side. And as you know, there's certainly plenty of data to back that up. But what about on the fixed income side? Does it look better there? I mean, I've seen some data that maybe you're better off looking for an active manager, or at least you have better odds looking at an active manager in the bond category. I guess talk about performance. I just think it's interesting. We're seeing these flows into active ETFs, but yet if you look at performance data in general, again, historically, we know what that looks like. So help me reconcile those two.
Yeah, so the abundance of alpha potential is greater in fixed income than it is in equities. And that's not a sort of a hot take. That's identifiable in looking at the performance trends over many years. And part of it has to do with that fundamental law of active management, where it's your skill or your IC times the square root of breadth from that perspective. And the breadth within fixed income is quite wide. So if you have a high amount of skill, you can lead to positive alpha results from that perspective. Now, when looking at it last year, 47% of active fixed income managers were able to beat their benchmark in 2025. And that's across wrapper type ETFs or mutual funds. Just 32% of active equity managers beat their benchmark. So this idea of being a source of more abundant alpha generation, fixed income bears that out even just in last year's data. And then even like you were probably talking about this earlier, but in that active ETF category, you have derivative income ETFs or buffered ETFs that are active. And so, in a market that's upward trending like it was last year, they're probably going to underperform their benchmark, and their benchmark might be the S&P 500, but that's really unfair because they're more providing an outcome, not alpha. So now we want to, this is where categorization comes into play and it becomes really important. So now we want to just look at some of these big box major categories that are more used for alpha generating strategies. So we look across these 9 sort of big fixed income categories, and you're looking at, say, 60% of active fixed income managers beat the benchmark in those big 9 categories with an average positive excess return of 34 basis points. And you compare that to equities using those big categories. There's 11 of them, 31% of active equity managers beat, and they had a negative 3.13% average excess return. So more abundant alpha within fixed income because there's a broader breadth of securities to choose from, there's more opaqueness, and there's more ability for managers to implement their skill and harness some alpha potential.
In terms of State Street ETF, State Street does have a number of actively managed fixed income products. So I always think of the State Street double line total return tactical ETF, ticker TOTL. Do you want to talk a little bit about how State Street is approaching the active fixed income ETF space, or even just the actively managed ETF space overall?
Yeah, I mean, TOTL was one of those strategies in that camp that beat its benchmark, right? So TOTL had positive excess return last year, outperformed its benchmark after fees. So it's definitely one of those, and it's an interesting sort of statistic that we always try to highlight is that if you look at on a rolling 12-month yield perspective and volatility perspective, there's not one day in TOTL's history where it had a lower yield than an ag-based ETF or higher volatility. So the idea of higher income, lower volatility than the benchmark, that really sort of speaks to the benefits of active management to discern those relative value situations at individual security levels, sector levels, and be risk managed too from a duration, credit, and sector perspective. So TOTL is definitely one of those areas of positivity. Now, I'd say in terms of our approach in active, we have a lot of different sub-advisors in the active space. We have our own strategies, and there sort of speaks to our ability to provide the investor with a decent amount of choice in terms of the strategy within the category, and then what type of the manager that we're able to select, because we're bringing best of breed managers within the ETF format, including ourselves in some of our strategies as well, and really having that multi-manager platform for investors to not only select the strategies from, but to also hear from, to get lines of sight and insights into Blackstone, into Double Line, into Bridgewater. We did a complete, I guess, quote unquote roadshow or tour of the country where we had these managers speak on a panel. It's pretty rare that you get to hear from 4 or 5 different asset managers all within one room at a time from a single broader issuer at the same time as well.
Okay, so we've covered small caps, we've covered actively managed ETFs. The third area that you indicated to me that you're finding most interesting right now is this idea of portfolio resilience. And I'm going to let you explain this in more detail, but the way that I'm interpreting this is that you think investors might want to consider asset classes beyond stocks and bonds right now. Just essentially that investors should think about building more resilient portfolios. So do I have that correct?
That's correct. 100%. That's 100%. I don't need to talk anymore. But yeah, that's the idea, this idea of resilience and the idea of balance. And I think the idea of balance was quite on display in 2025, where it was the first year since 2019 that stocks, bonds, commodities, all at the same time outperformed cash. That hadn't happened since 2019. And I think it's a illustration how we're entering a new type of paradigm as a result of geopolitics, but also in terms of, we entered this year or 2025 where U.S. equities have been the winningest trade for the last 15 years. And what do we see a lot of portfolios in? A ton in U.S. equities. We see a massive amount of capital in equities and then, of course, into U.S. equities. And what we do know, even if you're in a 60-40 portfolio, 91% of your risk is being generated just by equities. So you're making a lot of the same bets. You're betting that equities will be the best performing asset class for the next 10 years. And within that, you're betting that U.S. equities would be the best performing asset class. And again, that had been the winningest trade. It's hard to sort of, think that the good times will stop. But, Nate, as a Kansas City Chiefs fan, I'm sure you can reconcile that, sometimes the future looks awfully different than the recent past because things can change. And one of the things that changed last year was the complete reworking of our global trading system and sort of the breakdown of global cooperation amongst large nations in a move towards more sort of contentious debate and more towards mercantilism, where the state is having a bigger primacy in the role of capital flow, where you're now dictating winners and losers from the executive branch. And again, that's not a political statement. You can just sort of see this play out in the headlines. And so what happened last year? Well, last year, 76% of countries within the MSCI ACWI index outperformed the US. That's the largest hit rate of outperformance since 2009. And their average outperformance, I believe, was somewhere to the effect of like 11%. That average excess return was the greatest since 2009. And so it'd be hard to fathom anyone that woke up on January 1st, 2025, and I told them that stat, because they had lived this experience where the US had been the best trade. Now, the US had positive returns. There was greater returns outside the US. Now, part of that has to do with where the move towards more modern mercantilism by the U.S. led to other states, other countries using fiscal policy impulses to boost their growth, and that supported their equity markets as well. But what it also has done is sort of inflict a bias to the upside on inflation risks. So inflation is nowhere near the Fed's preferred threshold, and there's more upside biases than downside biases on inflation as well. So what did you have happen last year? You had commodities with strong returns in terms of industrial metals, precious metals. You had gold having its best return since 1979 as a result of some of this change from a macroeconomic backdrop. And I think this idea of resilience is about balance and about being diversified across asset classes, across geographies, and across different economic environments. And I think you're seeing this continuing to play out every single day with more headlines about Greenland or other countries in, South America, Iran, like all of these other geopolitical flashpoints. I'd rather be balanced than concentrated. And again, concentration had been the winning trade for the last 15 years. But again, the future looks often awfully different than the recent past.
Okay, so first, that was a painful Kansas City Chiefs reference. But I will say congratulations to your Patriots. I'm going to take the high road here. Here, a couple things. So one is I think about potential ETF solutions here. You talked a lot about international, and clearly State Street has a full lineup of international equity ETFs. However, investors might want to gain exposure there. But as I was thinking through some State Street options for portfolio resilience, one that came to my mind was the Spider Bridgewater All Weather ETF. ALLW, all W's ticker, which I actually talked about this last week, Matt. This just launched last year, as you're well aware, and it's already approaching 800 million in assets. So there's been a really nice investor reception of this. Clearly, other investors are thinking the same way. And then you mentioned commodities. I mean, State Street offers the largest physical gold ETF in GLD. You have the lower cost GLDM. I guess just talk about some of the ETF options here to potentially enhance portfolio resilience besides international ETFs.
Yeah, I mean, also just sort of highlighting this idea that resilience is starting to maybe percolate within the investor's mindset. Last year, with the record run of gold, gold had record flows, right? Over 40 billion for the industry. Broad commodities had 3 billion of inflows. That's their second best ever. And then inflation-linked bonds. Inflation-linked bonds had their most inflows since 2021 and had 12 consecutive months of inflows as well, which that's the longest stretch since 2022. So this idea of resilience, of buying things that might zag when others zig or have maybe a reaction function to rising inflation dynamics, has started to percolate in some of the flows. It's definitely nowhere near the flows that we see into large U.S. equities. So again, you still see those concentration biases playing out from that perspective. Now, when we're looking at our suite, of course, the gold funds that you mentioned, GLD, GLDM, had sizable flows last year, had that liquidity leadership, the low cost leadership, all that good stuff that comes with it in terms of tracking the spot price of gold. We have inflation-linked bond ETFs. We have TIPX, which is 1 to 10 years, sort of cuts off that tail. Commodities, we actually have a broad commodities ETF as well, SERI, which has done quite well in terms of its performance in tracking the commodities benchmark, but then trying to enhance it with a roll yield component as well. And of course, I think one of the things that I see in terms of I would say a basic struggle, but sometimes there's that line item risk of owning inflation-linked bond ETFs because they have phantom income. They might not be paying. How does this dividend actually work? Why is this in my portfolio? It's at a loss because they're still a bond and they have a duration. As yields go up, they're going to fall. It's I thought this was supposed to work well against inflation. And same thing with commodities. Ours is a no K1, but sometimes the dividend payments based on the Cayman structure, and it gets a little odd from that perspective. And then gold, again, all of these things, these line item risks. That's why I just look to all W. All W in the single trade can get you that regional diversification because it's diversified across global equities and nominal bonds, asset class diversification because it has stocks, bonds, inflation-linked bonds, commodities, gold, and then, of course, that environmental diversification across different rising growth, falling growth, rising inflation, falling inflation dynamics. So I think it's one of the more compelling ones. And like you said, we're still less than a year from its inception, and the reception has been quite strong with All W, which I thought was one of the more interesting stats, is that it has had more than 10 million of trading volume in 12 of the last 13 days. So we've seen interest in 2026. But more importantly, All W has had greater than 10 million in trading volumes on 2/3 over the days over the last 3 months. So that momentum has been building, and we're seeing some really good interest.
Where do you see investors typically allocating to All W with, or better said, is this coming out of the equity sleeve of a portfolio, the fixed income sleeve? Does it depend on the investor? Just in general, how do you see investors and advisors thinking about that allocation?
The thing with balance is that, because this is a balanced strategy across those different aspects and foundations and pillars of portfolios, the thing with balance is it can kind of fit in anywhere you want because you have that balanced asset allocation mix. Now, I wrote an article about this because we get this question a lot. And I wrote, if anyone wants to search for it, it's on our website, statestreet.com/investment management. Or you can just search like how to include All W in a portfolio. This is a realistic client request, and we had their portfolio. I basically ran through the analysis. Because of the asset allocation mix within All W, you can take roughly 60% of your equity allocation. I think I have this math correct. 60% of the equity allocation, 40% of the bond allocation. Put All W in, you can actually get back to your actual parent stock bond mix, but then add in what you don't have typically in terms of inflation-linked bonds, commodities, and gold. So you can take it from both because it has both those asset classes already. And you can match yourself back to your broader asset allocation mix, but then extend yourself into areas that are perhaps uncovered at the moment.
Well, Matt, great stuff as always. So small caps, actively managed ETFs, and this concept of portfolio resilience. I like these. This will be fun to watch as we go through the year. Always enjoy hearing your perspective on ETFs and the financial markets. So thank you for that, and thank you for joining me.
Yeah, thanks, Nate.
That was Matt Bartolini, Global Head of Research Strategist at State Street Investment Management. That'll do it for this week's ETF Prime. I'm excited to tell you that I will be at Exchange 2026, where I will be taking the stage and even recording a live episode of this podcast. This is your chance to join me alongside a community of top advisors and industry experts for a few days of world-class content and unparalleled networking. Secure your spot today by visiting exchangeetf.com. Next week, I will be joined by Matt Buckland, who is founder of Exchangeify. We're going to be going in depth on 351 exchanges. And then I'll also be joined by Paul Marino, who is Chief Revenue Officer of Themes ETF. So we'll discuss their thematic ETFs and also their leverage shares products. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.